So the next item is finance costs, and this is your cost of borrowing. And this can get a little bit different based on whether you're a big public company and you have big lines of credit, or if you're a smaller builder and you're actually borrowing against this project. So there's one other aspect to this, and maybe let's think of this in terms of a smaller builder. You've got a financial partner and you're going to share profits with that financial partner, but they usually charge what's called a preferred return, or it's like interest on their money before you even start doing any profit splits. And that might be in these carry costs. Again, it's called the preferred return on equity. If you're also this private builder, then you got to go get a construction loan, and the construction lender is maybe charging you interest, I don't know, 5, 6, 7% for the construction loan. That interest gets put into this carry cost as well. I say carry cost, that's another name for finance costs. I'll say, what's my carry cost? I'm carrying it, interest costs during the life of the project. So now we're talking about a bigger builder, and they've got big lines of credit that you are going to have allocated to your project, and each project basically draws from this line of credit from a big treasury or finance department within your company. This is where I would go more to your accounting department and try to find out, what should I be putting in here as an assumption for my finance costs? So in this case here, I've got 4%. I'm not so sure that in a bigger company, this number could be a lot thinner because their borrowing costs are pretty cheap with the way interest rates are right now. If I was a private builder, this probably isn't enough, and maybe it needs to be more like 6% because, as I'd mentioned, I got to pay that financial partner his equity preferred return or interest on his money. Then I've got to pay the other bank loans as well. So, but I think as a general rule of thumb, interest rates are pretty low. 4%, isn't a bad number. I know years ago when interest rates were higher, I was putting in 7 or 8%, and obviously affects your costs. So, I think this is one where if you're an analyst, you've got to ask some people on this. This is a number that really gets fine-tuned more once you do the cash flow and you put in your assumptions, and you will really get more into how your cash flow model will calc out this number in a lot more detail. The other one then you'll see here is overhead. And the overhead is generally all of the costs that go into your home building division. The field costs, such as we talked about the superintendent, that's out there inside in the temporary facility, and your salespeople, those are usually referred to as the field people. Those are generally in different cost items. The overhead is everything that's in your builder office. So this would be your division presidents, all your VPs, your managers, your administrative help, and it also includes the rent for your office space. It includes all your computers, everything that keeps your project running, on an annual basis. This one also comes from accounting, because I've seen in this case where you'll have this number range from anywhere from 3 to 6%. And sometimes it even includes a corporate overhead. So maybe you're a division in a region and your number is 4%, but the way your corporate office works, they apply or allocate a 1% number to your project to cover all the costs that are in their corporate office. So I generally look at this number and I say, it's anywhere from 3 to 6%. I put 4% in here, which I think is a pretty fair number. Again, I would go to your accounting department, and you'll probably already know this, and they'll say, well, we're using 4% as the overhead number in all the projects, and that's typically what you'll use from project to project to project. It doesn't generally change unless maybe at the end of the year they're finding the costs are higher, and they'll say, let's use 4.5%. But again, go to your accounting department and you can get a better number on that. So the last item here is warranties, and we sort of touched on it a bit about the construction defect liability insurance in the insurance line. The warranty is generally the costs that go for a warranty policy. And I've seen this more and more that essentially they'll buy for the homeowner a 10-year homeowner's warranty policy, which is a really nice feature as a home buyer and you're buying a new home. You pretty much know in the first year the builder is going to take care of every defect that's in your house. Something isn't working right, and maybe there's a leak, maybe something broke. And by the way, that builder is probably going to subcontractors, and he's got a subcontract that subcontractor's got to come out and fix that item. But then after that 1 year is up, then basically, you've got a 10-year policy that essentially the home buyer's got the benefit that something goes wrong, they've got a homeowner's warranty policy that they can call on. And this is generally, there's third-party uh, insurers that provide these warranties, and they're the ones that the home buyer is going to call. But essentially, the builder has allotted, in this case, 1% or about $5,500 per home. They've paid for that policy for that home buyer, and it's part of their costs. So, what I'd like to make a comment about all of these soft costs, other than the direct costs, is if you add up all of these soft costs you see here, they're roughly 19.5%. That's another rule of thumb when I'm doing a pro forma. Again, it could vary from which market you're in and location and region, but I look at that and go, well, that seems to be about right. 19.5% for all of my soft costs. The directs are 25%. Everything else is 19.5%. I've seen this number range from 15% to 22%. Again, the big public builder, maybe they're a little bit more efficient in these costs, or the project's bigger, it can be more efficient. If it's a bit more of a smaller project, or you're a private builder, your costs are a little higher, maybe because interest costs are higher, financing costs. That's what you're looking at as another metric. And like I said, I'll look at this and go, 19.5%. I'm pretty close. I'm going to keep my eye open that maybe I'm a little fat or maybe I'm a little lean on it, but I'm right there in the ballpark. So, this now has all of our housing costs. We've got all the vertical direct constructions, all of the soft costs, and we've talked about the land costs. All of our costs have been accounted for.